Most of the companies think that they can manage the financials in a better way without any planning and working. But the actual scenario is when you go for a financial arrangement, you have to first see what is in your numbers. So like if you are going for getting a loan from a bank and bank is offering a loan at the rate of 23% per annum, then you have to see what is your capacity to generate cash, whether you can generate cash more than 23% when you inject this money or not. So if the capacity of your business is earning more than what you are required to pay to the bank, then you are in a safer hand to get the financing. The other thing that the businesses have to consider is for what they are using the loan. Like the mistake commonly committed by the entrepreneur is they get the working capital for day-to-day operations, but at the end they try to manage investing it in the machinery or getting the cars or getting the home financed, and this makes the mismatch unmanageable. But the scenario for using is different for the different kind of loans, and the mismatch of repayment and utilization can trigger a financial emergency in your company. So first thing you have to consider is if you are getting a loan from a bank or from any other financial institution, you must assess the capacity of surplus generation by your business. And number two, where you are investing these funds. If you are investing in a cash generating asset, then it is a good match that you are committing a repayment with the institution, and on the other hand you will getting the surplus cash from the cash generating unit. Like you committed a lease liability with the bank for a car, and you managed to give this car to a rent-a-car company who will use this car and pay you a monthly installment, which of course is a few thousand more than you are required to pay to the bank. Then it is not going to create any squeeze in your monthly income, or you are going to have a financial emergency. But if you take a loan from the bank and buy a car for your own traveling, then what will happen? It ultimately squeeze your income, put an extra pressure on your disposable income. So ultimately, to pay to the bank, either you will have to squeeze your expenses, or you have to go for a second or third job to pay to the bank liability, or if not, you will have to make a bankruptcy arrangement. So the two important things that you have to consider while taking a fun loan from a bank is: number one, take a loan if your cash generation ability is more than what you are committing with the bank in terms of repayment and in terms of interest rate. The second thing is always prefer to get a loan for a cash generating unit, for a machinery, for an asset, or for a business which generate cash, so that you can repay from the additional resources, not from the existing resources. So this is what you have to consider while trying to make an assessment whether you should apply for a loan or not. Thank you very much.